Hello, everyone, and welcome to our second Quantum Valuations FAST30 webinar. Our goal is to share clear, practical ways to use IP and other intangibles to lift deal value, support growth, and strengthen governance. For those new to quantum valuations, we are a specialist firm that helps companies articulate and defend the value of their intangibles for transactions, governance, and tax. A quick housekeeping note, today's session is being recorded. We will share the replay link and the slides with all attendees after the webinar. Please post any questions in the Q&A panel as we go. Today's topic is on the Intangibles Playbook. This 30-minute session will show how corporates and fast-growing businesses can sharpen their competitive edge by managing intangible assets with the same rigor as financial and physical assets. Today's topic has been the brainchild of Tim Heberden and Biljana Smith. Tim is a world-renowned specialist in valuing intangible assets and is the author of International Valuation Guidelines on Intangible Asset Valuation. Biljana is the chair and former CEO of Fishburners, which is Australia's leading technology startup hub. She brings critical insights from an executive's perspective and someone experienced in seeing IP-rich businesses take off from the startup world. Unfortunately, due to unforeseen circumstances, Biljana is not able to join us today, but her insights and inputs have been integral to the presentation, which Tim will share with us now. We will take a few questions at the end. Tim, over to you.
Great, thank you, Jack. Well, the intention today is to stick to the FAST30 billing and get to the meat of the playbook as soon as possible. However, the context of the presentation is really important. So let's start with that. And the initial question is, what is driving intangible, or the extent to which intangible assets are driving corporate value, and the implications of a blind spot? Now, Quantum's research has covered most major stock exchanges in the world. For this example, we'll focus in on the ASX and the split of the enterprise value of the top 200 companies between asset categories. Across the market as a whole, tangible assets, net tangible assets, only contribute 35% of value. And if one looks across the three industries we've used as an example, that drops down to 5% once we get to tech and digital. The intangible assets that actually appear on balance sheet is a fairly modest share of enterprise value, only 13% for the market as a whole. And that leaves a large portion, 53% or 78% in tech and digital, which is unreported intangibles. Now, a point that Biljana was keen to stress is, why is such a small proportion of intangible value on balance sheets? And it's mainly due to restrictions in financial reporting. So a lot of internally generated intangibles cannot be capitalized, for instance, brands, and technology assets, for instance, only the development costs can be capitalized, so any increase in value is not shown. So first point, intangibles contribute an enormous share of value. So for these areas, it's between 65 and 95% of total enterprise value. And unfortunately, a lot of them are not visible on balance sheets. But in terms of what are the implications of that, we've now drilled into the food and beverage industry just as an example. And this intangibles multiple looks at the extent to which intangible assets amplify each dollar of net tangible assets. So for the lower quartile of global food and beverage companies, that's 0.9. So it means for each dollar of tangible assets, there's less than $1 of extra intangible value. Whereas the upper quartile, intangibles amplify each dollar by 7.4 times. So they're clearly working a lot harder. And as we go through the playbook, you'll see the correlation between strong intangibles and performance. So there's this blind spot on balance sheets. Yes, financial statements give us lots of information about expenditure and other cash outflows. We get information about revenue on the right-hand side, although, you know, it's often a single line despite all of the effort that goes into generating it. And then one can get the free cash flows. And if one assesses the risk of a business, one can calculate its enterprise value. But in terms of the middle, the asset base, which is generating the revenue or cost efficiencies, not much visibility of that. That's where we use our value mapping process to identify the different cogs which make up the mechanism of a business, how it acquires new customers, how it retains customers, how it generates a price premium, how it has cost efficiencies relative to its competitors. Now, obviously, this map, these cogs, will vary between industries in terms of the type of assets that are more prevalent, but even within industries, according to companies' strategy and capabilities, the size of the cogs and their interaction will differ. Again, a point Biljana and I discussed, there are obviously specialists in all of these fields in terms of brand strategists or technical management experts or data scientists. But the point that we're getting is that unless the executive team and the board have an understanding of the relative importance of these assets now and their potential value, they might not have the right capabilities in-house, or the teams responsible for those assets might be under-resourced. So it's this bridging, this blind spot that we'll discuss further. Based on the size of the intangible cogs, the contribution of intangible value, one would have thought that boards would be all over them. But going back a few years, when presenting at an AICD event, I conducted a Menti poll and asked a range of questions to the 50 delegates. It turned out that 85% didn't get regular key performance measures on any of the intangibles. And a very modest proportion had anything more than mild confidence in the management of their IP assets. Unfortunately, we also find when we're conducting client engagements that this blind spot permeates within the company and different management levels. So I would have thought that this would be a cause of great concern for executives and board members. And certainly it is for some, and they get on top of it and improve any gaps. But there is this fairly common unspoken response to that sort of information that we've provided. And it's the response that, well, but our company performs well. That seems to be suggestive that we're managing our intangible assets okay, that they'll keep doing their job. Well, they might keep doing their job until they don't. And our key point is that a rear view mirror method of managing intangibles is not smart. If we look particularly at IP assets being a subset of intangible assets, people often focus on the kind of more attractive aspects of them, the scalability, the fact that they can be worth much more than they cost to develop. But that ignores the full complexity. For instance, that nonlinear returns means that you might spend an enormous amount in research and development, but have a worthless asset. And similarly, the functionality of the assets can be complex. The strength of the protection might be less than obvious unless you have specialist advice, and they're hard to measure. Doesn't mean they can't be reliably tracked, but often they are put in the too hard basket. So let's focus on some of the risks that you really should be protecting against. The first is leapfrogging of technology, where you become obsolete. Plenty of examples if one looks back in time, whether it's Kodak or whether it's BlackBerry or others. Then there's damaged reputation without the right tracking mechanisms, without the right response mechanism. Some companies have found out that this could be terminal, Arthur Andersen being an example. Data breaches, again, plenty of examples in most jurisdictions. And then at the bottom, that insidious gradual decline of competitive advantage through your intangibles relinquishing that competitive advantage. So getting back to the rear view mirror being unacceptable as a method. So here we've got the current asset base. If you do just assume those assets will keep doing their job, you might be really wrong. In this example, the technology platform reduces in strength. Maybe there was technical obsolescence, maybe a competitor launched something much better unexpectedly because you weren't scanning the environment. Well, you might argue that you don't just use the rear view mirror. You do have a 3-year plan or a 5-year plan with forecasts and lots of words indicating why those forecasts are reasonable. And, this might look familiar. Here we have something, last 3 years, compound annual growth of 7%. Next 5 years, forecasting that will be 8%. That's hardly a heroic increase. It might seem okay, but you can't judge forecasts in isolation. And in this instance, let's assume that the market itself has a 5% forecast growth rate. So this assumes you're growing faster than the market, but once again, there could be good reason for that. Now, even if you haven't bridged your forecasts to the market and to your asset base, there's kind of an implied assumption there. In this instance, the implied assumption is that you're growing faster than the market, both in terms of revenue and profit margin, but you're spending the same amount on your intangibles as you had historically. And also, because of the 5% v 8% increment, you're assuming that you grow faster you're assuming that your asset base is achieving that superior growth rate. Now, let's say one took the trouble to do some detailed market mapping and to stress test key intangibles. In this instance, there's some technical debt in the platform. The data capabilities weren't as strong as they should be. So that's actually showing a weakening of the asset position, which implies that it's far more likely that there's going to be below market growth, and resulting in a far more reasonable expectation of growth is between 4 and 5% rather than the 8%. So we'll drill in further to this ability to bridge the relationship between what you do, what's happening in the market, and what's likely to occur in your future results. But let's get to a happier scenario. This is amplifying the value of intangibles. And strong IP assets in particular yield improved performance that can come through higher growth, price premium, cost savings, capital efficiencies, or a reduction in risk. And in particular, IP assets, because of the protection, that those can be sustainable advantages. So let's have a look at our research once again, and we'll stick to the food and beverage industry by way of example. And this is looking at the EBIT multiple. Once again, a big difference. The lower quartile, 12 times EBIT gets you to the enterprise value, whereas the upper quartile, 22 times. And those upper quartile companies, further analysis shows, have really strong IP assets, which are yielding those benefits and that incremental value. So if we get back to our friends, the cogs that are driving the business performance, Here's an example where a company uses a temporary advantage from a tech platform. And let's say this tech platform is just protected by its complexity and copyright and trade secrets. That's not going to be maintained forever, but it uses that period of advantage to capture all of the data generated by the technology to strengthen its brand, and through all of those increase its customer assets. So there we have the leveraging integrated effect of the intangibles. I'll now jump into 3 case studies, and there is an extra one snuck into the steps in the playbook. This first one is quite a simple situation. So we had a client which built and operated health clinics, and they developed significant know-how, both in the design of the clinics and what design yielded efficiencies and improved patient service, but also in the actual every element of operations. Now, so often that's left in people's heads and it's kind of patchily applied. This client captured and digitized that know-how. And if one looks in this little matrix, vertically, we've got the earnings potential of the know-how and the extent of control on the other axis. And when it is just kind of amorphous know-how in people's heads, you have low control and lesser earnings potential. But by capturing and digitizing that, it becomes a separable asset, it becomes a scalable asset. And not only did this client ensure then that know-how was applied in each and every one of their centers, it also generated a licensing opportunity where a Chinese operator paid them almost 2% of revenue to use their know-how so that they too could share in those efficiencies. So that's good amplification from what is often considered a fairly unsexy sort of intangible. The second example looks at brand value. So the situation analysis, we had a retail brand. It was very well established, a good share in its core regional market, but management was attracted by the growth into adjacent regions. And the way they kind of funded the brand extension into those regions was pretty much to take budget from the core region. Now, the good situation is we'd done multiple years of brand evaluations and brand tracking and had a good understanding of the causal relationships in the business model. And based on the brand equity research within the core market, we compared it at the current time, the orange line, against a couple of years earlier when it was at its peak. And then based on our understanding of the relationship between brand investment and brand equity and market performance, we were able to anticipate the impact of that continual reduction in investment in the core market. And once that was expressed in terms of the net present value of the proposed strategy is, yes, there would be value added in the new regions. And although there was a high growth rate, the modest size meant that was much less valuable than the loss of value in the core region resulting from that gradual decline in brand equity. And that was a net loss. Now, the good news is that piece of analysis was done early. It was presented, it was accepted by the market research team, the finance team, and the strategy was changed. The investment in the growth markets was maintained, but not at the expense of the core region. So hence we had captured the value without losing any in the core market. So once again, it's visibility, its connection of different types of information in a value chain. Another example that we get asked to evaluate frequently, the particular instance here, we had an R&D project with associated IP that spent tens of millions on it, but a change in the chief exec, a change in priorities, that was regarded as non-core. And a decision had to be made whether to just terminate that project, cut the losses, or continue developing it, or were there other forms through licensing and joint venture. Again, this is a simplified sort of final slide at the end of a project, but what went through for management decision making. So different investment profiles, different risk profiles, different time to market, different earnings potential, and all of those were evaluated, and a decision to out-license the IP was made, as that reduced the risk of further wasted investment. It reduced just kind of throwing away what had been developed, and it had a high probability of success with the highest value outcome. So there we go. Let's get into the playbook steps, where we'll show you a little more about the kind of process that we carry out to unlock that value or protect that value. So 4 simple steps. Firstly, it's a very broad review of the external landscape. Secondly, mapping. So both that asset identification, flow charting, and grading, leading into valuation or scenario valuations, which help inform strategy selection, resource allocation, risk management, so that one can protect and amplify intangible value. So step number 1 is the market landscape. And I kind of can hear everyone saying, well, obviously we all look at the market landscape. But what we encourage is a very broad perspective. So some of these are fairly typical when one's looking at macro and micro trends, one's looking at industry trends, competitive forces, and obviously financial benchmarking. But in addition to that, there are a range of really rich tech and IP sources, which can give a much better understanding of what's likely to happen in the future and prevent you getting into rear view mirror obsession. And then the other common area we look at is trends in stakeholder attitudes and requirements. So not just customers, but a range of other stakeholders. We'd often use trade-off research, and we might conduct statistical analysis of different information sources. And just by way of example, here's if one, over the last 10 years was looking at the patent landscape in financial services, you'd have seen even in the period 2007 to 2012, banks should not just have been focusing on their traditional competitors and fintechs, but also on the tech companies, the big gorillas, who had far more, or were getting far more patent applications in financial services areas than either of those companies. Either of those competitors. The implications are obviously really significant in R&D and IP and in corporate strategy, because those big sophisticated tech companies then have the ability to prevent the freedom to operate for the banks unless they enter into licensing deals, or they might find they conduct research, but then they're unable to activate that research. Now, identification of intangibles, another step in the mapping. Once again, it sounds obvious, and getting back to the balance sheet gap and the fact that most companies' registers and so on only list registered IP, patent and trademarks, maybe listing of software and so on, but a lot of the assets are invisible. So we always use this iceberg analogy, where most of the intangibles, you almost have to tease it out through a series of interviews, through using a structured approach to identify them. And here, similar to the cogs that we have, but we're showing the different types of rights that can underpin different assets. So, for instance, technology, it could be patents, trade secrets, designs, copyright, and so on. But it's making sure that one goes through this thorough process to identify the intangibles, and then that plugs in to the mapping and the grading process. I mentioned I'd use another case study to show the mapping and grading. So here we have a sophisticated listed company with a good corporate finance team looking to make an acquisition. They realized this was a very intangible rich acquisition. They didn't have the skill set to do it. So they got a specialist team to do so. We're looking at the cogs again, but in this instance showing them as bubbles, and the blue circle represents the importance of each asset at that particular date, whereas the dotted outer line shows its potential to grow within a 3-year forecast period. And that wasn't just hope value. Part of the mapping process, we gauged the capabilities, the infrastructure. Was it up to the challenge of capturing that value? But as the core asset was the software platform, we did a deeper dive into that. So this is our grading process, which we typically use now to evaluate a technology asset and have similar tools for data and brand assets. But this is showing, based on an analysis of the software platform, including technical benchmark and marking and discussion with their patent attorneys, there were actually 2 scenarios because there was some uncertainty about the level of patent protection. But in any event, that didn't really move the dial. Either way, the technology was good enough to be the central cog and get the business operating, get the business turning, and start generating the generating the data and strengthening the brand. So this summarizes the analysis. So we've got that mapping and grading process on the left, and then that feeds directly into the earnings and risk modeling. So understanding the acquisition, the retention, understanding the pricing policy, understanding the capital efficiency and the risk. So rather than just a bunch of numbers in a spreadsheet, we really understood the drivers of that value, and we're also able to benchmark the quality or different comparable financial measures. So this is the concept we refer to as the bridge, because all of those feed into the financial forecasts, feed into a range of different perspectives on value. And in this instance, we show how we looked at different discounted cash flow valuations together with prior funding rounds and comparable multiples. The interesting case is, in this instance, the analysis justified the asking price, but having visibility of the risk profile as well as the earnings, the board chose to be a customer rather than an investor in this particular technology. So I'm pleased to see that I'll stick to our FAST30 promise as we get into the conclusion. We've really focused in this time on the strategic benefits of protecting your IP and other intangibles and amplifying these assets. But even if you're not convinced, even if you're happy with a kind of rear view mirror approach, other stakeholders aren't. So tax authorities in particular are really demanding that multinationals identify their intangibles with specificity and show where and how that asset has been generated. And similarly, it's not long before there'll be more investor demands for better disclosure of intangibles. This doesn't mean they have to be on the balance sheet, but just having better information. And for instance, the IP office in Singapore has released an intangible asset disclosure framework, which companies in Singapore are encouraged to comply with. It's not mandatory, but once things are out there, questions tend to be asked. It's the strategy, identification, measurement, and management. Some information, obviously, without giving away your competitive advantage. So ultimately, our playbook, we would say that the conclusion is that without effective evaluation and tracking of your intangible assets, your strategy will be compromised. You're unlikely to protect and amplify that value. And those dreaded blind spots will result in hidden risks and missed opportunities. A very weird alternative source is OECD transfer pricing guidelines, getting back to the tax interest in that topic, where they say it's not sufficient to suggest that vaguely specified or undifferentiated intangibles have an effect on arm's length prices. And in a broader strategic context, that arm's length prices covers kind of any form of competitive advantage. So perhaps, the final point to measure is certainly boards have the same duty of care towards their intangible assets as their physical and monetary assets. And that flows through to, executive teams and specialists. But we've just got a few questions that you might like to ask of your own visibility or the potential blind spot. Can you reliably estimate the contribution of each of your core intangibles to business value? Can you identify the specific rights supporting that asset and who's accountable for it? Do you track the health of each of those assets forward-looking? Do you benchmark their performance? Number 4, do you frequently scan a range of market landscapes and stakeholder attitudes? And do you integrate a careful assessment of intangibles in your M&A and your tax compliance? And ultimately, once you've got all of that, one assumes that the question of do you have the capabilities to manage those assets effectively will be one that will be self-evident. So there's the 100 miles an hour sprint through the context, and I'll hand over to Jack to see if we've got any questions from the audience.
Thank you very much, Tim, and thank you for the wealth of knowledge and for sharing this powerful framework for looking at intellectual property and intangibles and what can be done proactively to maximize the impact for corporates and growth businesses. We do have time for questions. Please add them in the Q&A panel now, and I will group themes as they come in. While we're collating the questions, it strikes me that even though intangibles do not appear on the book, they have very real value for impacting business performance, transactions, and intrinsic value. So, Tim, if a company wanted to make real progress in the next 90 days, for example, what would your 3 steps be in order, and what would success look like for such a board?
Great. Jack, yes, I would call it a stress test, and it needn't be a heavy-duty, detailed, massively time-consuming project. The first step is identification of intangibles, and again, in a first step, one can do it at a fairly broad brushstroke level. The second step is the mapping process to gauge their relative earnings contribution, the size of the cogs, and including a bit of benchmarking and including any sort of broad gap analysis in terms of the capabilities. If it's a listed company, one can start estimating the contribution of those assets to enterprise value, or you could even do some very high-level indicative valuation work. But I think the key thing is it's similar to the staircase we showed earlier, but it can be done at a much higher level kind of first step process, and typically that really gets all stakeholders within a business kind of really interested and kind of wanting to know more.
Fantastic. Thank you, Tim. We do have a question from the audience. It's from KK. The question is your methodology applicable only to certain size of companies and not really for SMEs? Thanks.
No, it's applied differently to different businesses, and the complexity of going about it can be higher for really complex businesses. But no, we do a lot of work for early stage businesses, both, that can be an absolutely crucial time for them to make sure that they understand the implication of different decisions, particularly where they've got kind of cost trade-offs to make, and they recognize cost benefits. So it can be crucial, and we've tailored products for that to be kind of digestible for smaller companies.
Thank you, Tim. And so it seems that intangibles can shrink, and the value of that could shrink if not proactively managed. And eventually, the business may lose their competitive advantage if it's not an area of focus.
Yes, it can shrink, and I guess it's that gradual shrinking, which is sometimes not detected before it's quite late. It can also kind of just deflate massively quickly if kind of something that had presumed to be protected, for instance, is not protected, or something that was deemed to be kind of a new thing turned out not to be so.
Right. Thank you, Tim. Another question is, why should businesses seek experts in mapping and valuing their IP and intangibles, and when should they consider professional valuation?
So I think the first thing is, why should they? It depends on the internal capabilities. So if you can do all of that in-house, that's great. But most organizations, even if they have good skills in different areas, they don't have the integration. It's that bridge concept that I discussed. So, once again, one can work with an external firm in terms of what you do internally and what advice the external firm gives. In terms of the time, kind of today is a lot better than tomorrow. We're in a very fast-moving market. Technology is changing really quickly. So a point I make is that rear-view mirror approach. You can get by in good, comfortable times when kind of all boats rise with the tide, but this isn't one of those times. It's evolving rapidly. And if you leave it for the day after tomorrow, you might already have lost an opportunity.
Fantastic. That brings us to time. Thank you, Tim, and thank you to everyone who joined. We will send the replay and slides to all attendees. For updates on future FAST30 sessions and insights on IP valuation, follow QANTM Valuations on LinkedIn. We look forward to seeing you at the next session. Thank you.
Thanks.